Welcome to Honeycut Investment TV. In this episode, we're going to take a look at Netflix. So Netflix has a spectacular business model. It's a wide moat business. Everything's great. Does that necessarily mean it's a great investment? Well, the answer is no. In fact, I don't think it's a good investment. And the primary reasons why, the biggest one is just an extremely elevated valuation. The stock it's priced way too high right now. And the second reason is weak free cash flow growth. So I think that's another factor to be concerned about as an investor. Now, before I focus on the negatives, I want to look at the positives here. And Netflix's income growth over the past couple years has been pretty strong. In 2012, income was around $17 million, and it's grown to $267 million in 2014. And you can also see big improvement on the operating margins. They've increased from 1.4% in 2012 up to 7.3% in 2014. So Netflix is seeing significant improvement on these metrics. All right, so we looked at the good. Now I want to look at the bad. And the free cash flow picture is not very good for Netflix. And you can see here, it's just downright ugly. In 2014, I calculated free cash flows at negative $265 million for Netflix, and it's been getting worse over time. And this is, and there's two big factors here that I want to look at. The first is the high stock expense, stock compensation expense. This is often not factored into free cash flows, but I put it in there. And this number has grown significantly over the years. So I think it's worthwhile to look at. It grew from $13 million in 2009, and then up to $115 million in 2014. So as an investor, I do not like that number. Now the next thing to look at, and this is the real big driver of the negative free cash flows, is content acquisition costs. Netflix has seen content acquisition skyrocket from $530 million in 2010 up to $3.85 billion in 2014. Now, from a business perspective, this isn't necessarily bad. What they're doing is, as their subscriber base grows and their revenues improve, they're being more aggressive about acquiring content. And what this does is allows them to build an even bigger moat for the business. So I think from a business perspective, this isn't a bad strategy. I just think it showcases why the stock is a bit pricey right now, because people are assuming free cash flows that may not materialize anytime in the next decade. Now I want to look at two a little bit different measures. The first is free cash flow margins, and this one, this shows a negative 7% free cash flow margin for 2014. And the second one, this is a bit of an oddball custom measure I made. This is revenues minus direct costs minus operating expenses minus interest minus taxes. So sort of an oddball metric, but I came up with about $200 million in 2014. I'm not sure if this is a really valuable metric or not. I was just trying to come up with something here as an alternative way to look at Netflix, and this is what I came up with. On this measure, Netflix comes out okay. It looks better than free cash flows, but tough to tell, basically. Valuation time, and my best guess for Netflix is I think the stock is probably worth about $20 to $30. It's currently selling, as I'm doing this video, at around 115 to 120 range. So that's significantly above the $20 to $30 range. So in my view, Netflix is very overvalued in spite of being an excellent business. Now I want to look at a bull case and a bear case as well. My bull case scenario, this assumes very strong growth, and you can check the article out to get a little bit more on the details. But in the bull case, I come up with a valuation in the $40 to $60 range. My bear case puts Netflix at about the $12 to $20 range. But the biggest thing I want to emphasize is that it's almost impossible to come up with a valuation of over 100 for Netflix without just using insane numbers. So here were the assumptions I had to use to even get to a valuation of 100. I think I got 108 for this. That was 30% revenue growth for the next 3 years, 25% revenue growth in years 4 through 6, 20% revenue growth in years 7 through 10. Then I had free cash flow margins up to 15% by the end of that period. And even with those very aggressive assumptions, I could only come up with a valuation of $107. So I do think Netflix is a very good business model. I think it deserves a premium valuation. Even my most probable valuation is probably kind of conservative, 20 to 30. I could see paying 40, 50 for this stock. I cannot find a way to justify, though, paying 115, 124. I think at that point it's pretty much priced to perfection. You basically have very little upside. So conclusion time, I think Netflix is an excellent business. I think Wet Hot American Summer is a great example of how Netflix's data advantage is playing out, and it's able to generate content that has value that no other entertainment studio would have ever realized. But at the same time, this stock is just way too pricey right now. I would not touch it unless it fell back below 50 sometime in the next 12, 24 months. All right, that's it for this episode. Thanks for watching. I'll see you next time.